Hi everyone. Okay, so it's Sunday and time to just reflect on the markets, and I've already made a post about the fact that we've seen the markets down 16% where we're at now, and had hit a 20% downside just at that recent low earlier in the week. Now, we've got one day left of trading until the end of the year, so I thought let's take a bit of a look at where we're at and let's just have the mindset that maybe this market is going to recover in 2019. So it's all doom and gloom at the moment. That's what we see in the headlines. It's what we see out of the markets itself. You're probably seeing it with your investment portfolio. Traders may be experiencing some difficulty in their trading approach as well. First of all, let's just take a look at the key visual that we have available at hand. So the S&P 500 index, which is the key index I use, is up in front of us. And here we can see it's been in this downwards trend. We had a sideways trading range form in through late November into December, where a pullback in the markets, 10% pullback, resulted in a consolidation. And then with continuing trade wars with China, with the Fed Reserve looking to raise rates, with government shutdowns, with numerous factors influencing investor sentiment, we had a pretty strong sell-off in the markets, pushed the markets down a further 10%. For overall, as we see here, about a 20% decline in the markets. So we've just had a little bit of a rebound, and I'm not one for catching a falling knife or what I refer to as bottom fishing, trying to pick up something from the bottom of the lake there. This is a downwards trend, lower highs, lower lows. It's classic formation. We have high volatility reflecting that downwards trend, which just shows uncertainty amongst investors. However, what we also have is what we denote as an oversold environment. Being oversold, this is using a stochastic, and this is a modified stochastic that I'm using here. It's a double stochastic, and I've actually removed some of the components because of the way that I've set up this particular indicator shows me a change in market momentum. Now, momentum in the markets doesn't necessarily mean that things are changing for good. It just means that on the short term, we might have a bit of a change from what has been occurring. So we've seen selling pressure and a little bit of a rebound over the last few days. Hence, momentum has changed. It's not a trade signal as such. And as many of you will know from what I do in the markets, I'm not looking for specific indicators to go, that's the trigger, that's what we do. I'm reading the markets, I'm positioning myself, and then I'm managing positions, and that's how I approach the markets. When I take a look at the shorter term activity of these candles, we have a pretty strong rebound on day one there, on that reversal point, but the momentum of that buyer activity is slowed down. It could be for a number of factors, most of which would be because we are at Christmas, that period between Christmas and New Year, and there's very little activity historically that ever occurs in that time frame. Personally, my short to medium term portfolio, I don't have any positions at all. I haven't had a position since basically the break to the downside. I had a bear put position on, I took profit in that, and was just monitoring for whether this would hold the support. It broke through, and I wasn't going to be chasing this. So now where we're at, let's say that we do have this mindset. The markets are down 20%. The economics haven't changed. Economics won't change because the stock market is a leading indicator to economics. But what if this is the low of the markets? This is where everyone's going to start seeing that we have bargains. They'll start to accumulate, will consolidate, and a reversal will occur. Now, we haven't seen anything as severe as this downwards market for some time, but we did see early in 2018 that the markets had corrected themselves, consolidated for a period of time, and then started a new upwards trend. If we say that trend started, was really in May was the start of the trend, even though the lows were back here, you could say that between February and May was a very difficult market environment where it chopped and changed up and down. And with my trading activity, I had less activity during that time frame. And then as the markets formed the trend, I rode that trend, kept pushing that trend all the way through to the top. I started to put some short positions on in through here, but I also did get caught out with a few positions on this downward shift through here, and that took a little bit of shine off the performance of the year. So what if we are in an environment that is going to be positive for 2019? How would you approach that? Well, look, how I'm looking at this is that certainly right now is not that entry point. Now, I'm not a market timer, someone who's trying to get the ideal low and the perfect high and time my entry and exits off that. But what we're reading out of this market, the points I mentioned just before, don't show me that we have a shift back into some buyer confidence coming into the market. First of all, as I mentioned, that short-term rally in through here has lost its momentum very quickly. Again, that could just be the time frame, Christmas to New Year's. So as we get into the first week to 2 weeks of 2019, that may give us a better picture. I'd like to see some consolidation, some support holding, a bit like where we were before, prior to it breaking. And how I would approach that is certainly very similar to what I was doing back at this point in time. Rather than just buying, going long, I use derivatives or options. So I reduce my risk. Instead of just going long, I put in a lower risk position with, I guess, a reduced potential of return, but also something that doesn't need it to just keeps going upwards for me to make a decent return. So I use option strategies in sideways trading markets. If we have a sideways trading market form, then for the investor, it's a great opportunity to accumulate. It doesn't guarantee that we won't get another break to the downside, but we certainly need to see some pretty poor economic data for us to have another break to another low below 2350, because that then is bear market environment. And in that bear market environment, I certainly, as with the expectation of 2019 being bullish or positive, once we break 2350, if that was to occur, I would be reducing portfolio size. I wouldn't be buying new positions. I don't think accumulating stock positions at that point in time would be a great approach. For me, it would be just cash up a little bit more and just patiently wait. Bear markets don't last an exceptionally long time. They really only occur up to a maximum of around about 18 months. Anything longer than that, and there's some serious economic problems in place. And there's a different way to approach the markets in that type of environment. But for now, we could possibly wait for a bit of a short-term retracement and start to find some level of consolidation or not breaking into a new low is probably the best way to put it. We start to consolidate a bit more, and then it's going to come down to how strong these candles look as it's coming down and as it's going back up. We need to see some confidence from from investors and from traders. In that scenario, we'll start to see implied volatility dropping. That's a very positive sign. If it comes back down towards this 15%, then we're going to start looking at an environment that also isn't showing fear. If implied volatility stayed high above this 20-odd% level whilst we were consolidating, I probably wouldn't have as much confidence in the market. Now, I use the directional movement indicator as well. It's a backup of trend analysis. And that's the premise behind everything I do, is based on trend analysis, not based on short-term momentum trading. So we would like to see a positive reflection on this. We'd see the black line moving down, the green line crossing that black line, and of course at that point it should be above the red line as well. So the positive DI will break above the ADX. A typical scenario like that back in this period in through here. Mind you, that was after it had been consolidating for some time. So this is somewhat of the environment we'd like to see. So if I just go backwards just a little bit there, what you'll see is probably the ideal scenario that I'd like to occur over the next few weeks. Now, this is a longer time frame, but a consolidation that then starts to shift into an upwards trend. That would be the ideal scenario, but we don't always get ideal when it comes to the markets. So the hardest scenario to trade would be if this market starts to just trend upwards. Now, that caught me out in 2009 at the end of the GFC, the global financial crisis. I wasn't quite prepared based on economic data, which again is a lagging indicator to the stock market. But based on the economic data of March of 2009, when the markets hit their low, I wasn't willing to go long and accumulate and just buy up. By May of 2009, I was more than willing to start to accumulate stocks as we started to get into a new upwards trend. So that time frame, that couple of months time frame there, I'm willing to not be in the markets or give back a little bit or have very little exposure and just have confidence in the market change being in place. So that would be the same sort of scenario through here. Now, how I'd approach that if we do get a very strong rebound is that I'd be looking more so for the fact that, that's not what I wanted to do. Sometimes this gets a little bit pedantic. I'll just remove those. But what I would prefer to see is that this market gets back above that previous support level. If we can have some degree, and this is just classic technical analysis here, if we can have some degree of a low point forming off that support base, then that then shows us a change in trend, higher lows, higher highs, and a bit more confidence in what we're doing. So I would start to accumulate again. At that point in time, we've broken the downwards trend. We should start to see that the shorter 20-period moving average that I like to use is trading back above the 50-period moving average. And I use that 20-50 combination because most of my medium-term activity is month to month. My average trade size is about 19 days with an expectation of about a 30-day turnaround in positions. Now, some of you who are a bit more familiar with trading patterns might also consider the fact that that would be a reverse head and shoulder pattern. And that's all a head and shoulder pattern is, whether it's a head and shoulder pattern at the top of a market or a reverse head and shoulder pattern at the bottom of a downtrend. Those are typically just change of trend patterns. So you don't need to know this pattern, identify that pattern. It doesn't have to be perfect for it to occur. You need to be able to read the movement, the flow of the markets. So all things being equal, we head into January. We have a market that, or an economy, should I say, that continues to show some decent economic data. We start to see either some sort of consolidation. Maybe there's a bit more of a stronger buyer recovery. We then start to see some degree of a change in trend scenario. Confidence back in the daily activity, and of course our indicators help support all of that, and that would be the environment that we are going to be in a good position for accumulating quality stocks. So I'm not looking at bottom fishing high spec stocks and those having a potential high rate of return. I'm talking about quality stocks that potentially also have a dividend, because if we're going to have a tougher 2019, as the World Bank, as the Fed Reserve, all have stated that they're expecting a slowdown economically in 2019, then you don't want to be jumping on board stocks that are a lot more speculative. If you do like speculative stocks, then keep that as a portion of your portfolio, or if you're a short-term trader, then sure, you can still trade those smaller or more speculative type companies, but you need to make sure that you're very strict in how you manage your exit and reading of the markets too. Because if we start to falter again and fall into the next downwards leg, then of course those speculative stocks are going to be at higher risk of a larger downwards movement. So I'd be happy to accumulate above 2350 if we can hold that level. I'd be happier if we have a bit of a consolidation and break back above 2500. And otherwise, as we get into 2600, then I'll be adding again to the next round of increasing of exposure of the portfolio. I hope that gives you a little bit of insight into how I'm reading these markets. This is just using the visuals of the charts of the S&P 500. Of course, this is all being backed up too by my economic analysis, and then of course fundamental analysis of individual stocks. As many long-term viewers and readers will know, I tend to trade the S&P 500 mostly. That's the basis of what I do. And then I'll have some fringe positions on specific stocks or even other ETFs or other indices or specific market segments that I'll trade on the fringe as well. But the S&P 500 is the core of what I do with my trading. I get to focus in on one particular trading vehicle. I don't have to spend hundreds of hours researching everything else. And of course, with this, it represents the broader market. So then my top-down approach to analysis, economic, fundamental, technical, is then reflective of what's going on here with the sentiment on the chart. So if you've got any questions, please feel free to give me a buzz. Drop me a line, a personal message, or even just make a comment, and I'll be more than happy to get back to you on that one. I hope this has been a little bit insightful for you as an end-of-year wrap-up, one last final market review. And if it has been, please give me a thumbs up or even drop me a recommendation there. I'd be more than happy to have those online as well. So have a great New Year's, everybody. We'll look into 2019 and see where things kick off. And I'm looking forward to another exciting year for 2019. Speak to you again soon. Bye for now.